From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. And coming up, Powell's big pivot. The Fed chair hones in on the jobs market. He also sees inflation on a path sustainably downward. And yields drop in anticipation of rate cuts. But we begin with the big issue. In Powell's own words, the time has come for policy to adjust.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. While the task is not complete, we have made a good deal of progress toward that outcome. My confidence has grown that inflation is on a sustainable path back to 2%. Today, the labor market has cooled considerably from its formerly overheated state. The cooling in labor market conditions is unmistakable. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
Let's take a quick look at two-year yields over the past 3 days here, because here you have on Wednesday those payroll revisions and worries here about the job market being much weaker than initially had met the eye. Into the week, you saw some stability here, and it really yields rising once again just a bit because there was stability in the job market. Those jobless claims coming in line with expectations, and then you have today, the big day, Jackson Hole driving yields lower, a bit into the short end of the yield curve. An expectation that we will finally get that first rate cut after a historic rate hiking cycle. We stand in the middle of Friday with the 2-year at 3.92, just under 3.93, 6 basis points lower after that Powell speech. We're going to talk more about the implications here. Joining us now is Brian Rehling of Wells Fargo, Ken Monaghan of Amundi. Brian, you take a look at Powell's speech. This idea here that we are shifting really the focus from inflation, which he believes is on that path downward, to the jobs market. What is the worry about the jobs market weakening much further from here?
Well, I mean, we're a little past a level that I think the Fed would be comfortable with. If we start to see more deterioration, that could be really problematic for the overall economy. It's really been the consumer, the job market that's been holding things in here. The last monthly jobs report was not great. I mean, we're still in positive territory, so it's not as if we're in a real hurt at this point. But if things would start to deteriorate more rapidly, the Fed could definitely be behind the curve here. Again, that's not our expectation, but that's something to be on lookout for.
Do you think 25 or 50 makes the most sense for that first cut?
Oh, I think I think 25. I mean, the market's conditioned for 25. The Fed's conditioned the market for 25. The only way you get 50 is if we just have a terrible jobs print for the August jobs report. It's a very high bar for 50. This is also the last Fed meeting before the general election. So, while the Fed is definitely taking great pains to say, we're not going to be influenced by, the election calendar or politics, I think they would prefer to avoid needing to do 50 right before the election. So, again, very high bar for anything other than 25.
Brian, the market is still pricing in at least 100 basis points of rate cut through the end of the year. Why so much? If you have election uncertainty and both potential presidents here, both candidates are putting forward policies that could be inflationary, how does the Fed cut that much this year?
Well, I mean, any policies being put forth that are inflationary are potentially down the road and would likely require, one party can control, both sides of Congress and the presidency. So we're a long way from needing to price in too much of one party or the other winning and putting their policies into place. What I think we're looking at, we're going to see a continued slowdown into the fall. I think the market's just betting that the slowdown might be a little bit bigger. The Fed might be a little bit behind the curve. And again, either November or probably December, the Fed needs to come in with 50 to just kind of expedite the process.
You know, if they do achieve that 50 basis point rate cut, do you think that sends a signal to the market here that perhaps this economy is weakening much faster than meets the eye?
Well, I mean, that's a really great point, especially, you know, if it would come in September, because it's then what does the Fed see that the market doesn't see, that everybody else doesn't see? Again, unless it's substantiated by just really weak employment data, the bar is just exceptionally high to me to see a 50 basis point rate cut in September.
You know, we still have a lot of data ahead. We have PCE next week. We have jobs data. If you think about what's most important to investors, what are you looking for most?
Well, I mean, jobs is at the top of the list right now, no question. We've seen inflation start to take a back seat. I mean, the other thing that's really important to me, again, and this kind of goes along with jobs, is really to continue to see the consumer willing to spend, at least spend something. You know, that's really been a kind of consumer-led economy, always has been. And, you know, up until this point, people have felt pretty good. They have their jobs. We're seeing risk assets, equity markets hit very high levels. So your 401k feels good. Your other investments feel good. You're willing to continue to spend, at least at the upper income levels. If you start to see the job market deteriorate at a faster pace, people will really start to pull back. And again, that could be a point where there's kind of like this aha moment in the market where the Fed all of a sudden is behind the curve. And that would be a little bit more detrimental to risk assets, I think.
Up next, we're going to head over to Jackson Hole. Lisa Abramowitz will be live with Olli, Rehn, Bank of Finland governor and ECB governing council member. Of course, we are watching this rate story around the world. Stick with us. This is Real Yield on Bloomberg.
Welcome back. This is Lisa Abramowitz here in Jackson Hole at the confab of the Federal Reserve and central bankers from all over the world. The air is clearing a little bit as time goes on. We have with us someone from the other side of the Atlantic who I'm sure is watching the euro gain value versus the dollar rapidly with interest. Olli Rehn, governor of the Bank of Finland, former EU commissioner, a member of the ECB Governor Committee. Mr. Rehn, this to me was a seminal moment for the Federal Reserve, kicking off a rate cutting cycle. You already did that. You got ahead of it. I guess I want to begin with, does anything that you heard here change your view about how quickly the ECB can go?
I think it has reinforced confidence to the disinflationary process globally. Of course, the United States and its economy is central in the world economy. And as Chair Powell was very clear that this is now the turning point in monetary policy, and he is convinced of inflation being tamed. So that is a very clear message also for us Europeans, even though we are not the 13th federal district of the U.S. Federal Reserve System.
I know. I've heard this before. People come on and they say, we watch it, but we're an independent group. That said, we had on earlier Mauro Centeno of the Portuguese Central Bank, and he was saying September is an easy call. Do you agree?
A rate decision is never an easy call, but I think as we look at data for the moment, inflation is stabilizing in the long-term trend. I mean, there has been some, say, weaker data some time ago, but now we see more convincing data concerning wage growth, and we have to see the forest from the trees. The long trend in disinflation is on track. At the same time, the growth outlook in Europe, especially manufacturing, is rather subdued, weak. So, in my eyes, this reinforces the case for a rate cut in September, provided that we see data that disinflation is indeed going to be on track.
There was a belief earlier this year that the ECB would cut rates more significantly than the Federal Reserve. Right now, it seems like that could be shifting, and actually the Fed could be on course to cut rates more significantly than the ECB. Do you think that that's right? Do you think that given the fact that Europe and central bankers are more concerned about weakness, particularly in the biggest economy in the region, than in the U.S. Does it make sense to you that the ECB should be cutting less than the Fed?
2 points on this. First of all, we've seen that inflation, especially in this cycle, has been a global phenomenon. It rose globally and it has been contained globally. And now it is therefore no surprise that it is we are seeing a very synchronized reaction from the Fed, from the ECB, and from the other major central banks. The second point is that we have certain differences in the economic context between the US and Europe. In Europe, growth outlook is looking somewhat weaker than in the US. But nevertheless, there is plenty of similarities because of this disinflationary process now going on, and we both take our decisions on the basis of our mandate and on the basis of the economic data concerning our jurisdiction.
So we'll see. We'll see how it goes, essentially, right?
Well, we'll see, but we have already plenty of data to kind of prepare for our decision in September.
So there is this sort of expectation baked into markets that the terminal rate in Europe is going to be about 2.5%. One of the big questions we've had is, what is the ultimate destination for this cycle that we are embarking on, maybe globally? Do you think that's appropriate, 2.5%?
There has been some fluctuation in this assessment of the market data concerning the terminal rate of this rate cutting cycle. That's understandable because there is so much uncertainty, not least because of geopolitics in the Middle East, Russia's illegal war in Ukraine, and also because we are still seeing relatively strong service inflation, for instance, in Europe. So I think the conclusion of this is that we indeed have to have the big picture in mind, and for me, seeing forest from the trees means that the disinflationary process has been going on since fall 22, and it is still going on, and now it's a question of with which kind of speed do we cut rates so that it takes into account that we have to preserve price stability. That's our main mandate, and at the same time we take other considerations like the growth outlook into consideration.
Would you consider a 50 basis point rate cut?
Pardon me?
Would you consider a 50 basis point rate cut?
We have to always be open as regards what kind of rate cut or rate decision we do. But I don't want to commit myself at this stage. What we do is we take decisions on the basis of data dependence. That does not mean data point dependence, but the longer term trend. And we focus particularly on three things, three issues. One is the inflation outlook. The second is the underlying inflation neutralized from volatile energy and food prices. And third, the strength of monetary policy transition.
Right now we're seeing the euro strengthen. Earlier today, strengthened to the strongest versus the dollar going back to July of last year. Is that a good thing or a bad thing from your point of view?
For us, exchange rate is not a policy target. Yes, it has indirect consequences, indirect impact on inflation in the medium term, but we don't particularly target the interest rate. So our mandate is really price stability in the eurozone, in the euro area, and that's what we are focused on. That's the essential thing.
Olli Rehn, thank you so much for being with us. Olli Rehn was the Governing Council member and Bank of Finland governor, also a former EU commissioner. Thank you so much for being here with us. From a beautiful Jackson Hole, Wyoming, thank you so much. This is Bloomberg.
I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread. The week ahead, there's actually a lot coming up. Monday, we're going to get U.S. durable goods, and Tuesday, U.S. consumer confidence data, plus Nordstrom reporting earnings. Wednesday, we're going to hear from Atlanta Fed President Raphael Bostic, and all eyes will be on NVIDIA results. Thursday, another round of U.S. jobless claims, increasingly an important data point. And Friday, we're going to get U.S. PCE, the Fed's preferred gauge of inflation, and University of Michigan sentiment data. With us still, Brian Rehling of Wells Fargo and Ken Monaghan of Amundi, still back with us now. And you think about the week ahead and even the week after that when we get new jobs data. Ken, what are you watching as the more critical moments? Now that we know that a Fed rate cut is around the corner, the question is how much? How much will the upcoming data really guide that?
Well, I think unless we get something really unusual in the news on jobs data or see a lot more large-scale layoffs, that I think that the 25 basis points is all we should expect. For it to go to 50, I think would really require a fairly substantial change in what the direction is when we get that non-farm payroll number in September.
The one thing that I've been wondering also is, has the market been doing a lot of work for the Fed? I want to pull up this tweet from Harvard economist Jason Furman. Powell aggressively used open mouth operations, he said today. The Fed is exactly in the right place. Brian, if you have really yields perennially moving lower here, does the Fed even need to cut 25 basis points after September, 50 basis points as you expect?
Well, I mean, the Fed has always used their words to influence the markets and get the reaction that they're looking for. But, you know, they do need to follow through on their promises at this point. So, you know, do they need to end up doing 9, 10 rate cuts as, you know, Fed funds futures might suggest? You know, I think we're way ahead of the horse there. To expect that many. It's going to depend on the data, but you know, we have to get 2 or 3, really 3 rate cuts at least this year, or I mean, unless the data just comes out and is really, really strong, or else you know the Fed starts to lose some credibility, and they've taken great pains to build up that credibility.
Let's talk about the market implications as well, because we've seen some significant moves in the bond market over the last couple of weeks, both in the short end and the long end of the curve. Ken, where are the buying points right now, given the rallies that we have seen, even when they have been short-lived?
Well, you know, Sonali, the last time you and I spoke was on real yield on the 21st of June. And you may recall at that time, one of the other panelists was suggesting that a rate hike was still in the cards, which we discounted pretty hard. I think at this point, you know, you have to say to yourself that if you've already waited to put money to work from a duration perspective, you've missed out on much of it. So I think that the market is quite anticipatory here, and you know, as suggested, once we saw that data from the weaker jobs data in early August, the market reacted pretty quickly. I think if the Fed's still going to need to move here. And, you know, we still think that that 25 basis points move is the most likely one, not 50. But it's going to have to continue to move over the course of the year. Having said that, I agree with Brian that the market's gotten a little ahead of itself in thinking that we're going to see quite a substantial number of moves as the market might suggest.
Well, then what does that mean, Brian? If both of you believe that the market is getting ahead of itself, do you actually short certain parts of the curve?
Yeah, I mean, we took the opportunity when the 10-year kind of fell down to 360, you know, to take some profits there. We've actually been, again, for longer, you know, clients with a longer term time frame, been suggesting, you know, maybe start thinking what to do with some of those short-term maturities. Because again, if the Fed, even if they cut 4, 5, 6 times, you know, that yield, that return is going to start to evaporate. There might be better options elsewhere. So, you know, within kind of the fixed income maturities, you know, we're targeting intermediate term fixed income today, but, you know, I don't get too excited at these yield levels. I think to see yields fall substantially from here, outside, of course, the very short end of the curve, you're going to have a bigger slowdown, a harder landing, something break. Again, would not be our base case. So, right now, it's kind of playing defense and perhaps looking for opportunities when they present themselves during market volatility.
What about the curve steepener here? This has been a very popular trade across Wall Street for the better part of the last year. This has been a very long inversion. The 210 is still at about 12, 13 basis points when you look at that inversion. At what point does this curve disinvert, Ken?
Good question. Look, I think that there's a bit more room to move here. But, whether we're looking at the curve or we're looking at valuations in general, I think we need to recognize that, valuations are compressed here. You're looking at credit markets or credit spreads. Spreads are tight. There's relatively little differentiation between sectors and categories in terms of ratings. There's that old adage out there, you don't want to be picking up pennies in front of a steamroller. But I still think there's a bit of an opportunity here right now. That steamroller is not in sight at the moment.
Brian, Ken, we have to leave it there. That is Brian Rehling of Wells Fargo, Ken Monaghan of Amundi on a big day over at Jackson Hole and that Fed pivot in play. Quick check on the markets before we let you go from real yield. Of course, we have the markets on a tear after Powell's speech this morning. The S&P up above 0.5% nearly. Same goes for the NASDAQ 100. We have yields lower on the day. The 2-year at around 393, around lowest levels we've seen all week, 7 basis points lower. That does it from New York here. Same time, same place next week on a PCE day. Don't forget to join us. This was Bloomberg Real Yield, and this is Bloomberg.